What happens when a company buys all uranium? I'll tell you. It makes it theiranium. Hey everybody, Walrus here from Walrus Street, bringing you news and earnings for the week of September 6th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Well, here we go. We've capped out another week in the market. The S&P, the NASDAQ, and the Russell all did finish higher than where they opened the week. The Boomer Jones Industrial was down on the week, sadly, and Friday was pretty rough for a lot of traders. We had the release of the new jobs report, and I feel like I cover the jobs report every month when it comes out. I'm not going to cover it today because I just want to talk about it. The jobs numbers sucked. They were way below expectations, and this kind of killed a lot of confidence in the market on Friday. But even still, it seems like at this point, the only thing that's going to move markets strongly is going to be news about the Fed increasing rates. Other than that, it seems like everything is just not going to affect the zombie market. It's just going to keep marching upward overall. So even though we had a down day on Friday, we're still positive on the week. Whatever. And as far as the jobs report going down, this is something that I've been saying now for a couple weeks. I've been expecting kind of a down month in September. With the jobs report for the last couple months, we've seen that the job increases have been overwhelmingly in sectors that are seasonal, like seasonal hires in local education, where new teachers, new staffers, new faculty are hired over the summertime. We have seasonal hires in tourism, and I mean, August is the end of that season. So what did everybody expect was going to happen here on the jobs report? It couldn't be anything good, and sure enough, it just fell off. And I don't know, I feel like this is something that I've been talking about on this channel for months, and the fact that other people were surprised about it just kind of blew my mind a little bit. I don't know, maybe I'm missing something, but I thought that the decline here was inevitable in the jobs report. Anyway, let's get started with the news this week. For the first news story of the week, this is something that I've been keeping an eye on, but I haven't really jumped into yet. And there was a fantastic post on ARK Investing by user THRI54. He mentions a correlation between the Sprott Physical Uranium Trust launching its spot market at the market buys of physical uranium with uranium run-ups. And he says he thinks that Sprott's shelf program is literally moving the market on uranium. If you're not familiar, total global annual uranium production is in the neighborhood of about 130 million pounds. Consumption is about 25% higher than that. Sprott lists their uranium stockpile on a daily basis. You can see this on the website. I'll show you the links in a moment. As of Thursday the 2nd, they had 21.8 million pounds of uranium. They've increased 2 million pounds in the last 8 days. Daily global production is only about 375,000 pounds. Sprott's trust has bought 67% of the global uranium production over the last week. This is kind of crazy. I actually went ahead and researched further what this user was claiming, and I think they're absolutely correct here. I think Sprott is moving the uranium market. Now, if you've been following commodities for the last year or so, you know there've been like people talking about uranium squeeze, uranium squeeze, uranium squeeze, and I don't really like talking about squeezes. I don't like investing on the basis of a squeeze. But the fact here is, squeeze aside, uranium is typically a very illiquid market. If you think about it, there's really only a few buyers of uranium in the world, with a lot of environmental groups pushing back on nuclear reactor construction. Even though there's like 50 nuclear reactors currently under construction or planned to begin construction within the next 3 years or something thereabouts, there's still not a huge overwhelming demand of uranium. So what's happened is that uranium miners have slowed down their operations. They've stopped pulling uranium out of the ground because what do you do? Where do you store it? It's radioactive. It's kind of difficult to store. So we have the situation where these companies mining uranium are starting to bleed money because they can't actually make sales because there's not really enough buyers. But here you go, along comes Sprott Trust, and they're buying up the uranium stockpiles in the world. And I watched an interview with their CEO, and he said they've actually purchased most of the uranium already that was readily available, and they're already searching for secondary sources. And that interview was just from September 4th. which was like Saturday. So, I mean, this is as up to date as it gets, and Sprott is already searching for secondary sources. They're buying all of the uranium they can. So this is on Sprott's website, Sprott Physical Uranium Trust. Sprott as a company likes to focus on alternative assets for investing, and their whole purpose is to hedge the stock market, hedge traditional equity investments, give investors something that's not highly correlated with the stock market to invest in. And this Physical Uranium Trust trades like an ETF. Unfortunately, it's only available, I think, on the Toronto Stock Exchange in Canada, and it's not going to be available to US investors until next year at the earliest, if that even happens. They're up to 23 million pounds of uranium. Net asset value is $936 million. This is their press release. Sprott Physical Uranium Trust launches an at-the-market equity program. Our goal is to increase the scale and liquidity of the trust through regular purchases of physical uranium at the open market. We believe the ATM program is the most cost-effective and shareholder-friendly method to raise the capital necessary to achieve this objective while also creating long-term value for unit holders. They're issuing up to $300 million of units in this trust. Here is the uranium price. This is the spot market price of uranium. We know that the Sprott Trust launched on August 17th, and look what happens as soon as August 17th happens. We've had a steady increase in the price of uranium. From the 17th, it was closing at about $30.75. We're already up to $37.20, and this trust has only been trading now for what, a little over 2 weeks? This is nuts. However, if we go back to the max chart for spot uranium prices, we could see we're nowhere near the highs on the chart back in 2007, or even the run up again in 2010. That was around 77 in 2010, 137 for 2007, and right now we're sitting all the way down here. I mean, yeah, we're at a local high, but this is not anywhere near where uranium used to be. There are ways to play this if you're not familiar with any uranium companies. To be clear, I'm not advocating playing this, but there are some people that are going to see this and do their own research and wonder what to do. And there are ETFs for this, and there are single uranium miner companies that you can invest in, but I think the single companies is going to be really hit or miss as far as which way it goes, because it depends on whether or not Sprott ends up buying from them. So that depends on how much they have out of the ground already, what the production of their mine is right now, and I think there's a lot of variability. So playing an ETF on this might actually be a slightly better idea. But the funny thing is, I'm going to show you the charts are all basically identical. It almost seems like it doesn't matter which uranium equity you play, whether it's an ETF, whether it's a penny stock miner, whether it's a larger cap stock miner, they're all going up the same percent. So here we have the Global X Uranium ETF, URA, and here we have the North Shore Global Uranium Mining ETF, URNM. URNM reflects more so just the miners. URA has a wider range of uranium and uranium affiliated companies. So I think URNM is the better pure play for uranium, and I believe URNM gives you exposure to the Sprott Trust as well. And as far as assets under management goes, they're not huge ETFs, but they're actually kind of respectable. Even URNM has 368 million assets under management, and URA has 676. So this one's about half the size. URNM's about half the size. So let's take a look. This is Sprott's stock chart. If we go back to the 17th, which is when they launched this program to buy all of the uranium, the stock has been effectively vertical. We were trading down here around $8, a little above $8. We're up at $11 right now at close. In the same time period, from the 17th, we dipped a little bit, but then we've been rising straight up on URA. The other ETF, we dipped a little bit, and then we've been rising straight up on URNM. This is crazy. URNM is actually up like 50% in just the last 2+ weeks. Here's a penny stock uranium miner, Denison Mine. And Denison Mine, the same time period, August 17th, when Sprott started buying the uranium, we've increased about 40%. Here's another one, Cameco, CCJ. In that same time period, we started out at 1534, we're up to 2238. This is another almost 50% increase on the stock price. This is something that I noticed when I was doing my research, and this was totally independent of the Reddit posts that I saw. Every week I check the options to see what options are selling really well, which options are hot, because that's a good indication of which companies are in the public's eye right now. So I typically go to Barchart, I go to option volume leaders, and look at this. You have your usual culprits, Apple, Tesla. I see these every week, Nvidia. None of this is surprising, except in the top 15 options, I saw CCJ, 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 CCJ. Monday. Expirations in December, September 17th, December 17th, December 17th. I was compelled to look up CCJ, and I saw that it was Cameco, which is a uranium miner, and I realized, oh, there's something going on with uranium. About an hour later, while I was doing my research, I saw the Reddit post about the uranium trust with Sprott driving the market up, and then I saw the overlaps there, and I was like, holy crap, this might actually be something. I'm strongly considering getting into a position in one of these uranium companies because, like I've been saying for my last couple of videos, I'm starting to feel there's a bit of a downturn, and something that I noticed is that the uranium companies have a weak correlation with the overall stock market. This is a pretty cool tool you could use, portfoliovisualizer.com. It allows you to see asset correlations. So if we type in URNM, SPY, SPY obviously is the S&P reflective ETF. So you get a correlation of about 0.6. I mean, that's pretty good as far as two equities goes, but that's not great. So let's try the other ETF, URA. We get a correlation of 0.56. That's getting better. I mean, that's a really weak correlation. So let's check DNN. DNN was the penny stock. Denison, 0.49. Oh, wow, this is getting even better. It makes sense that a single stock would have a lower correlation than an ETF when you're comparing it to a stock market ETF, because there's more chances for the ETF to have some type of correlation, some type of overlap with the overall market with a sentiment-based move. So a single stock in this case is probably better if your goal is to hedge yourself against a stock market retracement. But then the one that I saw that was taking up all of those options buys on Barchart is CCJ, Cameco. Cameco only has a 0.42 correlation with the S&P 500. So I'm not saying Cameco is a good investment. I looked at their financials and they're actually pretty crap, but I'm thinking of doing some more research this week into this field. And if I do something, I'm not going to be buying options because the implied volatility, even on the ETFs, is nuts right now. We've had basically 2 straight weeks of a positive move upward. So if I do something on here, it's probably going to be common shares or like super deep in the money options where they would basically simulate owning the stock for a fraction of the price. But most likely it's going to be common shares if I go into anything here. And of course, as always, I will tweet about it to let you guys know if I decide to do something with this. The Sprott Trust trades in Canada. The US stock market is closed for Labor Day on Monday. The Canadian stock market, as far as I know, is not closed. So with all of the publicity that this is getting over the weekend, I imagine we're going to see the Sprott Trust shoot up in Canada on Monday. And if that happens on Tuesday, I promise you, you are going to see a massive move in the uranium sector in the companies that are traded on American exchanges. So what does this actually mean? You have a company, Sprott, that's effectively cornering the market on an illiquid commodity in uranium. What happens when a company buys all uranium? I'll tell you, it makes it their uranium. Next news story. Let's talk about something that's super negative and not fun whatsoever. The Social Security Trust funds now projected to run out of money sooner than expected due to COVID, Treasury says. Ah, yes, some more negative news coming out of COVID. This virus is the gift that keeps on giving. Don't even get me started on the Mu variant. The Social Security Trust Fund most Americans rely on for their retirement will run out of money in 12 years, 1 year sooner than expected, according to an annual government report. The circumstances which were exacerbated by the COVID pandemic threatened to shrink retirement payments and increase healthcare costs for Americans in old age sooner than expected. The financial outlook for Social Security and Medicare, 2 of the nation's preeminent safety net programs, has deteriorated over the last year. Here's the real kicker. Within the past 2 years, the program has started to draw down its assets in order to pay retirees all benefits promised. In other words, Social Security's costs in the form of monthly payments to retirees now exceed the income it takes in from U.S. workers. Projected to soon consistently operate in the red, the program's reserve fund would be depleted around 2033. Holy crap, they're drawing down their assets to pay the retirement benefits promised. This is as bad as it gets, especially if you're a worker and every week you see a Social Security payment taken out of your paycheck. You're effectively paying into something that at the moment looks like it's not going to be there for your retirement. People, let this be a wake-up call for you. This is why you're watching investment videos on YouTube. This is why you care about investing. Put your retirement into your own damn hands and don't trust the government to do it, because there's not going to be any money left. I know there's still some time to do something about this. I mean, 2033 is still a ways away. A decade's a long time in terms of policy. But the problem here is with all the baby boomers retiring and the population decline, there's simply not enough taxpayers to fund the Social Security program in the way that it's currently structured. And before some of my international viewers make a snide remark, let me remind you, this is not an American-only problem. The population decline is something that's affecting first world nations all around the world. And if you have any type of pension system that's set up on the backs of taxpayers, chances are your pension system is in trouble just like America's is. A lot of times we talk about birth rate and fertility rate when we're talking about population dynamics. The two can sometimes get conflated and misused. So really we should be looking at fertility rate. So fertility rate is the average number of babies born to females during their reproductive years. In other words, the total number of children that would be born to each human female if she lived to end of her childbearing years. The fertility rate can be influenced by social factors, economic factors, cultural factors. There's a whole slew of factors that influence the fertility rate, but the key takeaway is that we need a fertility rate of about 2.1 to maintain the current size of the global population. 2.1. Let's just think about that. Look at your groups of friends. How many of you think that your average friend has 2.1 kids right now? I can't think of any. When I was a kid growing up, I think the average family size had about maybe 2 kids, maybe a little less. But nowadays, 1 kid? Maybe 1 kid? 2.1 is really far removed from what we need here for the global economy to function. Half the world's population is reaching below replacement fertility. According to the most recent UN estimates, almost 1/2 of the world's population lives in countries with below replacement fertility, i.e. total fertility rates below 2.1 births per woman. Of these, 1/4 have TFRs close to the replacement level, i.e. between 1.8 and 2.1. The other 3/4 have really low fertility, below 1.8 births per woman. East Asia, very low. Japan, 1.5, China, 1.6, South Korea, 1.3, Taiwan, 1.2, Hong Kong, 1.3, Singapore, 1.3, Thailand, 1.5. This is bad. Canada's at 1.6. Brazil's at 1.7. Brazil's usually talked about as a growing economy. The US is only at 1.9. Australia, 1.8. New Zealand, 1.9. In Europe, everything along the Mediterranean is really low fertility. The Northern and Western European countries are close to replacements, but still below. Central Europe, yeah, forget it. Ukraine, Poland, 1.3, 1.5, 1.6. This is bad. What's my point here? It's not to scare the crap out of you, but really, I just want to urge everybody, make sure you're investing for your retirement. I talk about it all the time. I have my fun trading account that I just do my weekly trades in, try to make a buck, but really that's just kind of play money for me. My retirement account, I don't touch. That's like ETFs and Microsoft. I mean, that's like companies that I believe are going to be around forever, and ETFs because I know that everybody's smarter than me that runs those ETFs, and I'm putting my future in their hands with my own money. I'm not banking on Social Security to be there at all. And side note, it could be really easy to get very sardonic and cynical and dismissive and say, why am I paying Social Security out of my taxes for a program that's not even going to be there? You have to look at Social Security as kind of a pay it forward type program where you're still paying into it in hopes that the government gets its shit together and fixes it so that it is there for you. And also the payments that you're submitting today are going to be helping your parents into their retirement. So look at it that way. You know, you are still paying for a good cause. It's just probably not going to be there for you. So take care of yourself. Other big news this week, anything that comes out of ARK and Cathie Wood is big news because the people that are invested in ARK are really active on social media. So this week, Cathie Wood's ARK Invest has filed for a transparency themed ETF drawing on Tesla and Apple, but leaving out banks and energy giants. The fund excludes sectors including banking, fossil fuels, gambling, alcohol, and tobacco. If SEC approves the fund, it would be the second ETF launched by ARK Invest this year. The ARK Space ETF was the largest ETF launched this year. So this would be the second ETF launched by ARK Invest. Chances are it would be the second largest ETF launched this year because ARK is so popular. The index includes technology companies like Tesla, Apple, Microsoft, Zoom, Netflix, and Square, as well as companies from the food and beverage industry like Chipotle, which focuses on locally sourced food. Retail heavyweights like Amazon and Nike. I don't really think of Nike as an ESG friendly company. Sweatshops tend not to be very ESG like, but hey, whatever. Factors that impact whether a company can be added into the index include include whether it meets certain transparency criteria, its involvement in lawsuits and other legal issues, as well as the company's public reputation. I just hinted at it. This ARK Transparency ETF is effectively an ESG ETF. It's really important to note that this is not some novel, groundbreaking thing coming out of ARK. It's just another company making the ETF. We already have, quite literally, 50 ETFs on the market that classify themselves as being ESG ETFs. So, for anybody who doesn't know, what is ESG? ESG stands for Environmental, Social, and Governance Criteria. In recent years, as younger investors in particular have shown interest in putting their money where their values are, brokerage firms and mutual fund companies have begun to offer exchange-traded funds and other financial products that follow ESG criteria. Betterment and Wealthfront have used them to appeal to these investors. According to the most recent report from the US SIF Foundation, investors held $11.6 trillion in assets chosen according to ESG criteria at the beginning of 2018, up from $8.1 trillion just 2 years earlier. We have, like I said, quite literally 50 ETFs that can be classified as ESG ETFs. You have the iShares ESG Aware MSCI ETF, Global Clean Energy. The semiconductor ones can be considered ESGs. The First Trust Preferred Securities and Income ETF, this is the biggest one that's an ESG ETF with $7.5 billion assets under management. And it goes all the way down. And you could see, like, there's water ESGs, there's fintechs, gold miners. Anything that's ESG is very transparent by nature. Let's take a quick closer look at FPE, which is the First Trust Preferred Securities and Income ETF. I think this is something worth noting. On the chart, we can see in the last year, it's performed at about 9%, 9.5%. Year to date, it's performed at about 4%. I like ESG. I like it when corporations don't lie. I like it when they do things that are good for social causes and the environment. I don't like it when they throw those things in my face, but I think it's good for the general population when corporations take humanity first. But from an investor's perspective, ESG does not look like a great thing to invest in right now. 4% year to date for an ESG ETF for the largest one on the market. The S&P 500 year to date has returned something like 20%. So 4 is a little less than 20. I understand why people are excited about this. I understand why they want to invest in this. But for me, ESG alone is not a reason to invest in a company. I think that more and more companies going forward are going to be taking ESG principles into account. And even right now, anytime you see somebody's earnings report for their quarter or their half or their annual report, go through their entire slideshow. Near the end, on almost any company right now, you're going to see some slides about their ESG efforts. So every corporation is aware that ESG is becoming an expectation for them. But as far as a sole criteria for investment, I'm not entirely sold yet. Going from companies that are entirely clear and transparent about their business practices, let's talk about China. Heavily indebted Chinese developer Evergrande warns of default risk. The company cuts its debt to roughly $89 billion, but says idle building projects threaten its liquidity. Evergrande has warned it's risk defaulting on its debt if it fails to raise cash, as China's most heavily indebted property developer battles to stave off an unfolding liquidity crisis. The warning comes as Evergrande experiences the worst upheaval in its history, with a stream of recent problems raising questions over its access to financing, forcing to sell assets, and earning an unusual public rebuke from the government over its debt risks. As part of its efforts to raise cash, Evergrande is seeking to offload a stake in its electric vehicle business, which has yet to sell a car and whose shares have collapsed 80% this year. Ah yes, at least one thing is common between China and the US: speculative EV investments falling flat on their face, making people lose money and not producing a single vehicle. No matter how different we are, we're still alike. Seriously though, Evergrande is the largest real estate construction company in the entire world. And that's the only reason I'm covering this today. This is a big deal. It's not saying it's going to default, but it's saying it needs money to stop from defaulting so that it can cover its debts. The Chinese government is going to step in here. They are going to end up giving this company money. Now, that's not official news. I'm just predicting this because, hey, it's China and they can't deal with the international perception imagine if the largest real estate company in the world ends up going under because of a liquidity issue. So China's going to foot the bill here and end up subsidizing and socializing this country and taking part ownership. And there's going to be a huge amount of turnover at the top end of the company. But this could also be a sign of a bubble. There is a housing bubble in most Asian markets, and a lot of Evergrande's properties are in Beijing, which has one of the highest local inflated real estate price bubbles in the entire world. So this looks pretty bad. So let's see how this unfolds, but this could be like the kind of something that leads to a bubble popping. Who knows? We'll see. Either way, interesting story coming out of China. Continuing with China, China's Alibaba is to invest $15.5 billion for common prosperity. Oh, how generous of them. I'm sure they thought of doing this completely on their own, and they were in no way compelled to do this by the government. China's Alibaba Group will invest 100 billion yuan by 2025 in support of common prosperity, it said, becoming the latest corporate giant to pledge support for the initiative driven by President Xi Jinping. Beijing has been encouraging companies to share wealth as part of the effort to ease inequality in the world's second largest economy. Other companies that have made similar announcements include Tencent, which also pledged 100 billion yuan, and Geely Automobile. Interesting, since I made the video talking about how I was thinking about getting into some Chinese companies, Alibaba back then, when I made that video, was sitting around $150 a share. Currently, we're up to about 170.77, and this news is probably positive, not because they're spending money for something that's outside of the business, but because this means that they're back on the Chinese party's good side. So I guess maybe that means they're going to stop messing with Alibaba. I'm not really sure. Either way, the stock price is rising and looking pretty solid here for Alibaba, and I'm not the only one that thinks so. Now, this is Datarama. Datarama follows 72 like super investors. These are high net worth individuals and fund managers that are very successful. And like I said, there's about 72 of them on this website. In the last quarter alone, 12 of them have made substantial purchases into Alibaba. Their hold price is $226. So they're actually already in the red. But the fact that out of all of the stocks on this list, Alibaba is the most commonly purchased among the best fund managers and high net worth individuals in the world should say something about their view of this as a value purchase right now. So just to recap what I said a couple weeks ago, I'm not like in love with Chinese stocks. I still know that there's issues with auditing and transparency and, you know, no ESG whatsoever. But Alibaba and Baidu, which are two of my favorites, are trading at incredibly low valuations for what the companies offer. And, you know, we've got all these super investors investing into Alibaba. We've got Alibaba making amends with Zinni the Pooh, and everything's looking pretty up and up for the company at the moment. Now, last week I talked about an options play on American Eagle Outfitters. Boy, was I wrong on that one. I was totally right about the earnings, about the EPS beating expectations. I was even right when I said the online retail sales were going to be down. I mean, I was right down to the teeny tiniest little detail, except for the entire, you know, stock price going up thing, in which case the stock price tanked, and I was very, very wrong on that one. Bye-bye option money. American Eagle Outfitters reports all-time high second quarter revenue and operating income, reflecting strength across brands and great progress on our Real Power, Real Growth value creation plan. We've got a record revenue of $1.19 billion, increase 35% quarter on quarter, higher price sales, reduced promotions, controlled costs, fueled gross margin expansion up to 42%. 42% for gross margin for a retailer? This is actually really high. And their EPS, their quarterly earnings of 60 cents per share, beat the analyst consensus estimate of 53 cents per share by 13%. And this is a 2,100% increase over losses of 3 cents per share from the same period last year. So why did they fall? Their revenue came in at 1.19 billion. Expectations were for 1.23 billion. You serious? That's it? Okay. I mean, all right. I don't really have much to say here. I mean, this is another one where I got the earnings report right. It was great. It was a record all around for the company. And I mean, I'm even impressed by the fact that I forecasted the fact that their digital sales, their e-sales would be declining. Like, I nailed the hell out of that report by looking at their competitors' reports in the same industry. I was just wrong about the price. I don't know. I think for a while I'm done playing earnings options, and I'm going to be looking into something a little more long-term for the safety of my own trading portfolio so I don't blow it up at this point. So, yeah, Yeah, moving on. On that note, let's take a look at the upcoming earnings without the intention of playing any option this week. Not many companies reporting. You know, Monday's closed, so it's not really anything worth talking about. Tuesday, I'm not really too huge on any of these companies. UiPath is sort of interesting. Wednesday before open, Korn Ferry should be reporting killer earnings. This is a high-level staffing company. They're dealing with like executives and kind of white-collar type staffing jobs, and their revenue, their income for the last quarter on quarter, it's just growing explosively. I think Korn Ferry is going to keep going. Genius Sports is a cool one. This is one of those sports betting companies. They do a little more than that. They kind of offer a whole ecosystem, but they've been doing pretty well. Full stop, GameStop. Can't stop, won't stop. GameStop reporting Wednesday after close. Expect some fireworks or not. I don't know. I give up trying to predict any price movement after earnings, but either way, I do know there's a lot of people excited about GameStop earnings. Lululemon Athletica on Wednesday after close. We have some sporting good companies reporting with Academy Outdoor, American Outdoor, and Dick's reported some amazing earnings last week, so this also could be really good considering the theme. Also, summer's a big sales season for them. That's it for me today. I hope you guys enjoyed the video. I've got another video coming for you this week. Like I said, I'm trying to increase the amount of content that I put out. I did put out 3 videos last week. I haven't had a chance to go through comments, but I will at some point. As always, if you did enjoy the video and you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please be sure to like the video, subscribe to the channel if you want to be alerted to all my content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you soon.